Let me start with a question that sounds simple, but it will completely change how you watch the economy. So when you see a price, any price, are you sure you're looking at value? That's an important question. Or are you just looking at literally a number measured in currency that itself changes over time? So the concept and the big idea for today, money is a measuring stick. And that measuring stick changes. The entire world feels different, even if the underlying stuff hasn't changed, and oftentimes it hasn't. So this video is not going to be a prediction. I'm not here to tell you that the dollar is about to collapse tomorrow, and I'm sure not going to sit here and tell you that the dollar can't ever change. In fact, it is. So today I want it to be a strong educational video on currency, value, and trade. We're going to walk through the history of the US dollar, how it became the world's dominant currency, and why ultimately that dominance matters for global trade, and how the US government debt, Lord have mercy, fits into this story, and why changes we're seeing now, which is predominantly countries diversifying, why that matters. Look, I want you to pay attention to one thing as we go through this video. Most people try to understand the economy through headlines, but the economy is, well, for sure it's more than headlines, but it's compared to like plumbing. And literally, the pipes matter more than the noise. And by the end of the video, you'll be able to explain to someone else, hopefully, clearly, why the dollar has had such a powerful role, and why the role created benefits and trade-offs, and why diversification away from a single pillar changes the way the global system behaves. Then, maybe in the next video, we'll take this foundation and ask the personal questions that matter to you. How does a changing currency really change my environment and affect me, a retiree, or someone trying to save, or someone trying to lead a family? How does it affect my life now? But first, I want to build a foundation. So let's build it. Let's define 3 words that people use casually, but they're not casual at all. Currency, value, and trade. Let me say that one more time. It's currency, value, and trade. All right, so currency is the unit we use to measure and settle transactions, and Lord knows you guys already know that, but value may be something different. Value is what something is worth in real terms, what it can do for you, what it can buy you, what it produces, what it gives you. All those things collectively really amount to what value ultimately is. And trade is the exchange of goods and services across people, companies, and countries. And so here's the key. Trade requires trust. If I sell you something today and you pay me in currency, I'm trusting that the currency will hold enough value to matter tomorrow. So every global trade system at its core is a system of trust. Now, people often think that money is real because it's printed and everyone uses it. But money is like a social technology at its core. I mean, it's an agreement, kind of an agreement maybe that not all of us have actually committed to and uphold, but nonetheless, it's an agreement. And historically, that agreement was anchored to something scarce, right? We're talking about gold and silver because scarcity helps maintain trust over time, right? It's limited. If I can't easily create more of it, it's harder to abuse. And that's one reason hard money systems existed for centuries. But they had limitations too. As economies grow, trade expands, credit becomes essential. A pure commodity system can become restrictive. So history is basically a series of experiments in how to build money that can support growth without destroying trust. Now, let's move into the US dollar story and how it became the center of the modern global system. If you want the modern story, you have to start after World War II. The world needed a way to stabilize currency and rebuild trade, and that leads to the Bretton Woods system. Under Bretton Woods, the US dollar became the center, and foreign governments could convert US dollars to gold at a fixed rate. Other currencies were pegged to the US dollar. It became the comparison, the measuring tool, if you will. And why did the U.S. have the leverage to do that? So because the U.S. had industrial strength, massive post-war economic capacity, and a large share of the world's global reserve at the time, obviously that's leverage. So the world got a system that was stable enough to expand trade and rebuild. But here was the trade-off. When the dollar is the center of the system, the countries that issue dollars gain privilege. And, this is an important one, responsibility. Privilege, because the dollar becomes demanded globally for trade and services, but responsibility, because if you issue the world's main settlement currency, you have to maintain trust. You can't abuse it without consequences, and well, you can't do it at least forever. Over time, the U.S. ran larger deficits, and we know that. This is where the whole debt picture comes in. More dollars existed outside of the U.S., inflation pressures rose, foreign governments had the right to convert dollars into gold, and the math started breaking. Eventually, in 1971, the U.S. suspended convertibility of the dollar into gold. And the Federal Reserve's historical materials describe this as the end of the dollar convertibility and the beginning of the end of the Bretton Woods system. Over the next couple years, currencies moved increasingly toward floating exchange rates, similar to the life we live today. And that moment matters because it changed, ultimately, the measuring stick of how we justify the price of something that's valuable to us. So from that point forward, the dollar was no longer anchored to gold. It became a fiat currency, backed by the credibility of the U.S. government and productivity of the U.S. economy and confidence in U.S. institutions. Now, a lot of people, well, they hear fiat and assume that means fake, and that's not accurate either. Fiat systems can work. They have worked, but they require discipline, and they require a world where the purchasing power of money becomes a central issue over long-term horizons. Now, here's the next step in the modern story: how the dollar stayed dominant after leaving gold. Why did we all trust it? Because leaving gold could have been really a beginning to the end. Instead, a dollar became even more central. And why? Well, because the dollar wasn't just money. It became the world's deepest financial marketplace. If you're a central bank, a sovereign wealth fund, a global corporation, and you need a place to store large amounts of value that's going to be liquid and tradable and viewed as safe, you want deep markets. You want deep pockets, okay? The U.S. Treasury market became the risk-free benchmark for global finance. U.S. capital markets became the largest and most liquid. And the Federal Reserve, for better or worse, became one of the most influential central banks in the world, and because of its policies and how they affect the cost of dollars everywhere. So here's how this played out in practice. Countries produced goods. The world traded. Dollars were used heavily in settlement. Many countries accumulated dollars and often invested those dollars right back into the U.S. treasuries and U.S. assets. That arrangement created feedback loop, literally a system that supported dollar dominance. Brilliant, actually. And it created a different reality for Americans, a strong, dominant dollar, which tends to mean Americans can import goods more cheaply than they otherwise could. It tends to make global borrowing cheaper for the U.S. government. It can support asset prices by drawing in capital. But there's always a trade-off. No matter what decision you make in life, there's always a trade-off. A strong currency can make a country's exports less competitive. Well, this is the battle. That should sound familiar. It's one that we've been fighting for decades. It can encourage offshoring. It can hollow out parts of domestic industry over long periods of time, depending on the policy choices and incentives by the system, aka the federal government. And so the dollar's dominance is not purely good or it's not purely bad. It's a structure with winners and losers. Now, let's bring in the hard data that shows what dominance means today. The IMF's data, this is the official data set on the currency composition of foreign exchange reserves, shows that in 2025 Q3, not too far back, the US dollar accounted for 56.92% of the allocated reserves. That is enormous dominance in a world with many currencies. And at the same time, the Federal Reserve's 2025 note on the international role of the dollar points out that the dollar share has declined from its peak of around 72% in 2001. The dollar remains by far the dominant reserve currency, but that's notably a drop. And the Fed notes it. I mean, it's been basically unchanged since 2022, but obviously we went through a period where that dominance tended to change quickly. So if you want to summarize this in one sentence, I think I would put it this way. The dollar remains the center of the global reserve system. It sure does today, but the world has been gradually diversifying at the margin for decades. Now, let's talk about the next part of history, which is U.S. debt. Here's where people get emotional, and I want you to stay as practical as possible. Debt is not automatically evil. That's weird to say, but it's not. Debt is a tool if it's used as a tool. Otherwise, it's an indication that you're a slave potentially, right, to some other master. But debt can be a tool if it's used correctly. It can fund investments. It can smooth cycles. It can support growth. But a high and rising debt burden changes the set of future options, for sure. And that's the key. When a country has a large debt burden, its long-term choices compress. You can't raise taxes, reduce spending, inflate away part of the burden over time, and find new productivity and growth that outpaces the debt. Now, the U.S. government's debt is not a rumor. It's published daily. It's enormous. The Treasury's debt to the penny data set shows that on January 28, 2026, total public debt outstanding was about $38.54 trillion, with about $30.88 trillion held by the public. Those numbers matter because they influence interest cost, fiscal policy choices, and eventually the incentives that shape the monetary environment. And this is where, I'm going to go back to the very beginning, this is where the plumbing perspective matters. If you are the issuer of the world's main reserve currency, you can borrow more easily for longer than most countries can because of that trust again and that stability. The one reason the dollar has had its privilege, but privilege can become relative and dependent if it removes the urgency for discipline. Now, let's be very clear here. The existence of high U.S. debt does not automatically mean the dollar collapses. It does mean that the system becomes more sensitive, though. Policy choices become more consequential, and other countries have more incentive to diversify. So they are not fully dependent on one system. So what does diversification look like? Well, you see it in reserve composition right now. You see it in new trade arrangements. You see it in the growth of other currencies as a combined category. You see it in central bank gold purchases. I mean, look at last year, for goodness sake. The IMF coffers, if I say that correctly, COFER, the data brief notes, and this is the same data brief back in Q3, that other currency categories have increased over time. Clearly, the point is not that one currency replaces the dollar overnight. The point is that the world is building a wider bench, right? We get more participation around other currencies, more trust being spread out throughout the economic system globally. The World Gold Council's data shows central banks bought about 863 tons of gold in 2025. And that is a very large number historically. It's not the only indicator, but it's definitely a meaningful one. Now, whenever gold comes up, you'll hear people say the Basel rule made gold tier 1, like it's a secret switch. Some of the online conversation around that is definitely misleading and definitely overstated. The London Bullion Market Association has explicitly addressed misinformation about gold being reclassified as, I think it's like HQLA tier 1. I can't believe I got that right. That's okay. Tier 1 on a certain date. So the responsible way to say it is simple. You don't need a secret, story, if you will, or Basel story to explain gold's demand. Central banks buy gold for diversification, perceived neutrality, and to reduce reliance on any single country's financial system. And that's it. That's simple. Now, let's talk about the most important concept in this entire video, which is why dominance matters for trade. When a currency is widely used in trade, it reduces friction. If you and I trade the same currency, we reduce exchange risk. It's simple. I know what your money means to me because we're using the same money. If major commodities are priced in a currency, that currency becomes demanded globally. And when large liquid financial markets exist in that currency, global savings tend to flow there. It just makes sense. It's easier. It's simple. And this is why the dollar has mattered for so many years. It's not just the paper note, it's the entire ecosystem, payment systems, legal systems, market depth, the rule of law, liquidity, the sheer scale of the U.S. capital markets. And the Federal Reserve's 2025 note makes this point clear. Dollar dominance is supported by the size and strength of the U.S. economy and openness to trade and capital flows and depth and liquidity of U.S. markets, aka we've had leverage. We have. And so if you want the clean mental model, it's this. The dollar is not dominant because everyone likes America. The dollar is dominant because the system built around it has been efficient, liquid, and trusted enough to carry global trade at scale. Now, here is where the story gets interesting, because the same system that created stability also created incentives that pushed the world into a new transition. So what are the changes we see? Well, let's put them into simple educational framework. First, diversification is happening. Clearly, slowly, but it's still going to be meaningful. The dollar share of reserve is still the majority. As I mentioned before, it's not the peak as it was back in early 2000s or 2001, and it's definitely declined according to the feds, but it still holds its dominance. It still holds its current share and growth in other currencies. Second, gold has regained relevance as a reserve diversifier. We saw this last year, massive momentum to commodities, gold, silver. Again, not because gold becomes the new global settlement currency, but because it's a neutral reserve. And of course, it's outside of any single nation's liabilities. And of course, you look at like central bank purchases that have remained elevated, and you can see the transition from where the government's money is being spent and where they find security and comfort in holding reserve. And then third, the world is experimenting with payment rails and settlement systems that reduce reliance on U.S.-centered infrastructure. And that doesn't mean the dollar disappears tomorrow. It means the global system is gradually building alternatives, which we all know. Lord have mercy, we've seen it with cryptocurrency for quite some time now. And this is exactly what you expect in a world where geopolitical and policy uncertainty exist. More strength, more leverage, spread around globally. And fourth, U.S. debt changes the conversation. With total public debt outstanding around $38.5 trillion in late January 2026, it becomes harder to treat policy as, call it business as usual. Debt, service cost rate sensitivity, and fiscal choices, they become more prominent over time. And now, I want to be careful here. This is not a call for fear, but it's a call for understanding, because when you understand the system, you stop being emotionally driven by headlines and you start asking bigger questions. And so I want to leave you with 3 questions that you should be asking, or you should consider after this video. Whether you're an investor or whether you're a young leader of your home that's working and protecting your family, or you're a business owner trying to figure out what the next move is, how to borrow, how to leverage, or how to grow your business, or just someone trying to understand the world. Question number 1, what is the world using as the measuring stick for trade and reserve? And is that changing at the margin? Question number 2, how does U.S. policy, fiscal and monetary, affect the supply of dollars and the incentives for other countries to diversify? Question 3, if the world moves from a single dominant pillar to a more diversified set of pillars, what changes about inflation dynamics, interest rates, and volatility over time? And those questions are the bridge to where I'm going to go next in an upcoming video. Now, I hope you enjoyed the video. Once you understand the plumbing of our economy, we can talk about the personal implications and how it's going to affect you, especially for the head of household, the one trying to make the best possible decision for their family. And I think it matters. So let me close this video with the simplest summary I can give you as a wrap. The US dollar became more dominant because the US economy and its financial markets became the center of the global system after World War II, and because the dollar-based ecosystem created efficiency, liquidity, and trust for the world trade. That dominance created benefits, especially for borrowing and imports and trade-offs, especially for domestic incentives and long-run balances. Today, the dollar is still dominant, but the world is diversifying at the margins. Reserves are broader. Gold has reemerged as a diversifying reserve asset. And now settlement options are being explored. And a U.S. debt is growing. The importance of discipline, credibility, and good policy becomes more central, not less. In the next video, I'm going to take this foundation and answer those solid questions about your life. If the measuring stick changes, how do we build a plan that protects lifestyle, purchasing power, and peace of mind? How do we protect your financial future? I'm Andrew Nida with Asset Management Group. This was a helpful video that you enjoyed. Like and subscribe so you don't miss the next one. Take care, stay smart, make solid decisions. See you soon.